Hi, I'm Ryan Hanna, Chief Investment Officer at Cambridge Trust, now a division of Eastern Bank. As we enter the new year, I wanted to take a few minutes to reflect on 2024 and offer our perspective on what 2025 could bring. The last 6 months have been unmatched in terms of political drama. President Trump won a decisive victory and Republicans took control of the Senate while maintaining a razor-thin margin in the House of Representatives, putting all 3 branches of government in Republican control. As a result, we could likely see an agenda focused on pro-growth and pro-business initiatives. Lower corporate and income tax rates, less regulation, and tougher trade policies and tariffs with countries around the world. It's possible, if not likely, that could result in higher future inflation, higher interest rates, a stronger US dollar, and a faster pace of deglobalization. But what's on everyone's mind right now is the US economy, and things appear to be in good shape. The Federal Reserve pulled off what many thought unlikely, an economic soft landing, raising rates high enough to slow the economy while maintaining full employment and solid economic growth. In the third quarter, US real GDP grew at a pace of 2.8%, and while that was a modest deceleration from the second quarter rate, it still reflects solid, above-trend growth for an economy the size of ours. Short-term and long-term interest rates moved broadly higher across the yield curve and have become a headwind in certain end markets, like housing. We believe this represents a normalization of interest rates following over a decade of extraordinarily low rates borrowers had been accustomed to. So the recent rise has been an adjustment for many. That said, many homeowners took advantage of favorable rates over the past several years to lock in low, fixed-rate mortgages. And as a result, the homeowners may be less impacted by higher interest rates today compared to past history. Unemployment continues to hover around 4.2%, near full employment, despite the Federal Reserve raising the Fed funds rate from 0% to almost 5.5% in the 16 months between 2022 and 2023. After pausing for over a year, the Fed has now started to reduce interest rates, taking the Fed funds rate down 100 basis points in September through December. At Cambridge Trust, we see the combination of less restrictive monetary policy, a strong labor market with real wage growth, above-trend economic growth, and declining inflation providing continued strength in the US economy. The stock market has also remained strong. Most major stock indices, including the NASDAQ, the Dow Jones, and the S&P 500, are trading at all-time highs. While stock prices steadily increased throughout the year, stocks surged into year-end with the S&P 500 now trading over 6,000, higher by more than 29% year-to-date. In November alone, domestic stocks were higher across the board, with the S&P 500 adding nearly 6% for the month. The stock market's initial reaction to Trump's victory reflected the certainty of the election outcome, leading the Dow Jones to surge 1,500 points and small capitalization stocks to rise more than 6% the next trading day. Good or bad, the market likes certainty, and we had it less than 10 hours after the final poll closed on Election Day. Importantly, the breadth of the market rally has expanded nicely across many different sectors and industries. Gains are no longer isolated to the biggest names in the index or the Magnificent Seven, as they are so often referred to. We have seen improvement in mid and small capitalization stocks. Cyclical sectors, such as financials, industrials, and energy, have shown improvement recently, while defensive sectors have lagged. Broad participation in an upmarket is generally a healthy sign, as wider participation is indicative of the health of the rally. As America prepares for a new president to take office on January 20th, the months ahead will likely represent a year of transition, and with it, the potential for a greater degree of economic uncertainty and volatility. Despite these considerations, we expect moderating, yet healthy levels of economic activity in 2025. We believe the job market will remain firm, and the unemployment rate should remain well below long-term averages. Inflation should continue to moderate, but will likely remain above the Fed's long-term target of 2%. It's also likely that the Federal Reserve will continue to gradually reduce rates, adding another tailwind to an already strong economy. For all these reasons, we expect the U.S. economy to continue to grow, with an expectation that a recession is not imminent. Hopefully, this provides a baseline to build upon, and as we move further into the year, look for more from us focused on the most current wealth management and banking insights. Discover more insights at cambridgetrust.com.